What if I told you that the money in your wallet was never meant to make you free? What if the system you were taught to trust, the one that promises stability, growth, and opportunity, was quietly engineered to keep you permanently dependent? You work harder, prices rise faster. You save, but somehow your savings buy less every year. Governments print more. Banks lend more. Debt expands endlessly. And through it all, you're told this is normal, necessary, even good. But what if this isn't normal? What if this is design? Tonight, we're uncovering the story of fiat currency, how it began, why it replaced gold and silver, who pushed it forward when it broke, and how it may have quietly reshaped society into a system of permanent financial dependence. And the most important part, the real consequences didn't appear immediately. They unfolded slowly, invisibly, across decades. Let's begin at the beginning. For most of human history, money wasn't paper. It wasn't digital. It wasn't created by keystrokes. It was something tangible: gold, silver, copper, metals with intrinsic value, limited supply, and universal acceptance. Empires rose and fell using precious metals as currency. Trade expanded across continents because value was measurable and scarce. You couldn't print more gold. You had to mine it, earn it, fight for it. Scarcity enforced discipline, but scarcity also limited governments. When rulers needed to finance wars or grand projects, they couldn't simply create more money. They had to tax citizens or borrow from lenders. And that created political pressure. Accountability. Then came a quiet shift. Paper receipts were originally just claims on gold stored in vaults. You could exchange them anytime. The paper itself wasn't money. It represented money. But here's where the twist begins. Banks discovered that not everyone redeemed their paper at the same time. So they began issuing more paper claims than gold they actually held. As long as confidence remained, the illusion worked. This was the birth of fractional reserve banking, the ability to create money from debt. Now let's move forward to the 20th century. In 1913, the United States established the Federal Reserve. Officially, it was created to stabilize the financial system after repeated banking panics. It would act as a lender of last resort, a safety net, but it also centralized control over money creation. Instead of money being strictly tied to gold reserves, the central bank could expand or contract the money supply based on policy decisions. At first, the link to gold remained. Under the gold standard, dollars were still technically redeemable for precious metal. But cracks began to form. World War I demanded massive funding. Governments printed beyond gold reserves. Inflation followed, trust wavered. Then came the Great Depression. Banks collapsed, people rushed to withdraw gold. Governments panicked. In 1933, President Franklin D. Roosevelt took an extraordinary step. Americans were ordered to surrender their gold to the government. Private gold ownership was effectively outlawed. Soon after, the dollar was devalued. The link between citizen and gold was severed. But the global system still relied on gold through a new framework. After World War II, in 1944, global leaders met to design a new financial order. The result was the Bretton Woods Agreement. Under this system, foreign governments could exchange dollars for gold, but ordinary citizens could not. The US dollar became the world's reserve currency. It seemed stable, elegant, controlled until it wasn't. By the 1960s, the United States was financing both the Vietnam War and expansive domestic programs. Spending soared. Dollars flooded global markets. Foreign governments began questioning whether the U.S. actually had enough gold to back all those dollars. They started redeeming. Gold reserves drained. And then came the breaking point. In 1971, President Richard Nixon announced that the U.S. would temporarily suspend the dollar's convertibility into gold. Temporarily. That temporary measure has now lasted more than 50 years. With that announcement, the world entered the era of pure fiat currency. Money backed not by gold, but by government decree. The word fiat literally means by order. Money now had value because government said it did, and here's where the long-term consequences begin to unfold. Without the constraint of gold, there was no natural limit on money creation. When governments needed funding, they could borrow more. When economies slowed, central banks could lower interest rates. When markets panicked, liquidity could be injected. At first, it felt empowering. Economic growth accelerated. Credit expanded. Homeownership increased. But something else began rising quietly in the background: debt. Government debt. Corporate debt. Household debt. In 1971, U.S. federal debt stood at around $400 billion. Today, it exceeds $30 trillion. Globally, debt levels have surpassed $300 trillion. This wasn't an accident. It was structural. In a fiat system, money is created primarily through lending. When banks issue loans, new money enters circulation. But every dollar created carries interest attached to it. That means more money must be created to service previous debt. It's a cycle. Expansion requires more borrowing. More borrowing requires lower interest rates. Lower rates encourage even more debt. And the system cannot easily reverse because contraction triggers collapse. Now consider inflation. Since 1971, the US dollar has lost over 85% of its purchasing power. Wages have risen nominally, but housing, healthcare, and education costs have exploded far faster. Why? Because when money supply expands faster than real production, prices adjust upward. But here's the twist most people miss: inflation doesn't hit everyone equally. Those closest to newly created money, banks, governments, large corporations, benefit first. They receive funds before prices adjust. By the time money reaches average workers, costs have already risen. This phenomenon is sometimes called the Cantillon effect, and it quietly transfers wealth upward. Now let's look at the breaking point: the 2008 financial crisis. Decades of easy credit deregulation and mortgage expansion culminated in systemic failure. Major banks teetered on collapse. The response: massive intervention. The Federal Reserve launched quantitative easing, creating trillions of dollars electronically to purchase assets and stabilize markets. Asset prices soared, stocks recovered, real estate rebounded. But wage growth stagnated. Wealth inequality widened dramatically. Then came 2020. In response to global lockdowns and economic shutdowns, central banks worldwide injected unprecedented stimulus. Trillions more entered the system almost overnight. At first, markets surged. Then inflation spiked to levels not seen in decades. The pattern repeated: print, inflate, tighten, slow down, repeat. Now, let's connect this to modern parallels. Student loan debt in the U.S. exceeds $1.7 trillion. Credit card balances hit record highs. Housing affordability has reached historic lows in many cities. Governments run perpetual deficits with no serious path to repayment. Why repay when you can refinance? In a gold-backed system, persistent deficits would deplete reserves and force correction. In a fiat system, deficits can be monetized. The discipline mechanism is removed. And here's the deeper question: if money loses value over time, what are savers incentivized to do? Spend, invest, speculate. Holding cash guarantees erosion. So individuals chase yield in increasingly risky assets, stocks, real estate, cryptocurrencies, just to preserve purchasing power. Dependence deepens. You must participate in markets. You must take risk. You must stay employed in a system fueled by perpetual growth. Because the alternative, saving quietly, is punished. Now consider central bank digital currencies, or CBDCs. While still emerging, they represent the next phase of monetary evolution. Fully programmable, fully trackable fiat. Efficiency increases. But so does control. The question is no longer whether fiat currency works. It clearly does, at least in the short to medium term. The question is what it costs over decades. When money is untethered from scarcity, political incentives shift. Short-term solutions dominate. Long-term discipline erodes. Debt compounds silently, and dependence becomes normal. Think about retirement. Previous generations could rely on savings accounts and pensions. Today, Retirement planning requires navigating volatile markets and managing inflation risk. The system has changed, and most people never noticed when it did. So was this engineered? Not in the sense of a single mastermind plotting domination, but in the sense of structural incentives. Politicians benefit from spending without immediate taxation. Banks profit from lending. Markets thrive on liquidity. Voters prefer growth over austerity. Every participant responds rationally. The result, an ecosystem that requires continuous expansion to survive. Permanent financial dependence isn't enforced by chains. It's maintained by design. Debt-financed lifestyles. Inflation-driven asset appreciation. Policies that delay pain rather than resolve imbalance. And each crisis leads to more intervention, not less. More liquidity. More stimulus. More consolidation. Now let's step back. 3 clear takeaways. First, fiat currency removed natural monetary constraints, enabling unprecedented growth, but also unprecedented debt. The flexibility that prevents collapse today may amplify instability tomorrow. Second, inflation functions as a hidden tax, disproportionately affecting savers and wage earners while benefiting asset holders and early recipients of new money. Third, systems built on perpetual expansion face structural limits. Infinite debt growth in a finite world creates tension that must eventually resolve through inflation, restructuring, or transformation. So what happens next? No one knows exactly. Fiat systems have existed for decades, not centuries. The modern experiment is still unfolding. Some argue innovation and productivity will outpace debt. Others warn of currency debasement and systemic resets. History offers patterns, but not precise predictions. What is certain is this: money shapes behavior. Behavior shapes society. And when the foundation of money changes, everything built on top of it changes too. The real mystery isn't whether fiat currency works. It's whether we understand the trade-offs. If this video challenged what you thought you knew about money, take a moment to reflect on your own financial habits. How do inflation and debt shape your decisions? What assumptions have you accepted without questioning? Because once you see the structure, you can't unsee it, and understanding the system is the first step toward navigating it wisely. If you found value in this deep dive, consider subscribing for more long-form explorations into economics, power, and the hidden forces shaping our world. Share this with someone who still believes money is simple. It never was, and the story is far from over.